Hi, this is Brent with Trade Therapy, and welcome back to the Trading Couch. Microsoft was our Clarity Spotlight last week, and the lesson was really pretty simple. After an extension, late stage leaders don't need a bearish headline to pull back. Institutions harvest gains and then force controlled demand tests into prior decision zones to confirm support. The back test is the tell, not the headline. So the question we're going to answer in this video is really straightforward. Is Microsoft in a controlled test that's setting up for continuation? Or is this reset still incomplete and likely to probe lower before the next advance? Quick disclaimer before we get into the charts, this video is for educational purposes only. It's not investment advice. Trading involves risk, including the risk of loss. Do your own due diligence and manage risk according to your own plan. Full disclosure, we have no position in Microsoft. We're going to start with a look back to the weekly from November of 2025, which is the last time we looked at Microsoft. This weekly view really shows the full institutional business cycle context, including an accumulation phase that occurred in late 2022 at the bottom here, and then the first markup leg that ran throughout 2023 and into 2024. And this was the first real risk event where institutions had to decide whether or not they were going to defend Microsoft as a leader that was going to continue to lead the markets, or if it was going to distribute and then potentially come back down to this former reaccumulation zone. So this first reclaim right here is really what's important. It fell down into a prior zone here and then quickly reclaimed that. Although it was undercut later, this demand shelf that formed here formed the basis for reaccumulation. And this deep undercut of that shelf back to a former zone, which is this market structure tops there, really tells you all you need to know that this is campaign management. It is not abandonment. If this were true distribution, you'd see this progressively fail. You'd see these recoveries fail much faster. You'd see higher volume coming in, more supply coming in, instead of volume coming in at the low and buying up the back test of the structural top. And so this back test really set up this upthrust, and this sharp upthrust is really an interesting move that we'll get into when we get into the updated charts. But back in November, what we were seeing was profit taking. We believe this to be just profit taking from this sharp pullback. We noticed that price had come down to the 1618 in the previous top of the prior markup leg. If support held here, it showed that the former resistance was now turning into support. If it failed, it suggests that the market is rotating away from leadership and the reset might have some more work to do. If we jump forward now into an updated monthly view, we love monthly charts because it compacts the entire month into one candle. The thing that jumps out of this chart is these lower wicks here. If this were true distribution, we would see the opposite. We would see longer wicks on top continuing. We would see continued failure coming down. We've talked about this gap that was left open and how they like to use that as inventory control and also use that as a threat to retail investors thinking that price is going to come down and fill the gap. And that you see this long wick forming here on volume, showing that institutions are stepping in and buying the discounts. Again, if this were shifting into distribution, you'd see the opposite signature here. You'd see long wicks on top of these moving averages where Wall Street was pushing price up above that moving average and then bringing it back down below it, baiting people into it, not the opposite, pulling it down below the averages and then pushing it back up as the month gets down to close. This is really telling here that we're seeing that the monthly with long wicks on bottom that typically shows institutions coming in and buying up the dip. If we jump over to an updated weekly chart, the thing that really jumps out about the updated weekly chart are these back-to-back ABC corrective wave patterns. If we take a look at the first one, really looks like clean profit harvesting where institutions converted a portion of these unrealized gains into realized gains and cooled the extension without breaking the larger trend. Then you see this upthrust here. This typically serves as a liquidity draw. It lures in retail investors who chase. That allows institutions to take their profit and sets up this second ABC corrective wave. So the second correction is really designed to pressure those new buyers that stepped in. They chase the top here and it applies pressure to them, gets them out of the trade. Then you see volume coming in towards the bottoms, and that indicates Wall Street and institutional money stepping in. Distribution tends to be more persistent. We would not see volume coming in at the low here. We would see high volumes at the top, and then we would see some sort of a big supply candle here, pushing price back down below the support level, where now it's just coming down and testing the tops of these market structures and price reacting off of that. If this were true distribution, we would see an extended volume shelf. We would see a big volume spike here. We would see price beginning to cascade down. Not that can't still happen, but it hasn't happened yet. If we take a look at the leveraged lens and take a look at MSFX, that's the 2X long leveraged ETF. We like the leverage ETFs because it gives us a real quick snapshot into positioning and how volume's responding to the downside pressure. Very common to see these leverage tools really accelerate to the downside when it loses its moving averages here. And that's what we're seeing. But we're noticing is that we're coming down and we're taking out some of the inefficiencies of this big push in early 2025. You can see it come down to roughly about the midway point of this inefficient candle. And you do see significant supply coming here and rejecting off of the bottom side of the 55-week exponential moving average and pushing down only to see volume come in and buy up the low right at about the 50% level of that inefficiency candle. This all looks like normal behavior for a leveraged exposure. Does not look like ongoing distribution, does not look like ongoing supply. If we were to see additional big supply candles come in above average and pushing price down below obvious levels, if it were coming back down and testing these lows down here on volume, that would be different. We're not seeing that. We're seeing volume coming in and buying the dip at an area that we would expect to see volume coming in. It doesn't guarantee that this is an immediate bottom. It tells you that the leverage cleanup work is really active. This helps us frame the second corrective wave on Microsoft itself. So if MSFX starts to stabilize here, while Microsoft holds its level, it supports the reaccumulation thesis. If the leveraged ETF starts to fall and starts making clean downside progress with weak recoveries, that's a warning that Microsoft may be starting to lose its support. We may see a deeper test in Microsoft into Mag 7. If we jump over to an updated daily chart, the daily is really where demand tests become practical. This is where we stop describing the cycle and start measuring quality of the tape, the quality of the price behavior. Obviously, the gap is still here. Typically, gaps are used as inventory control. They mark a zone where price moved too fast, too quickly for a two-way trade to fully develop, and markets often revisit this zone later to test whether or not demand's going to step in and whether or not the gap will form a ceiling for a bounce, or whether or not demand needs a deeper reset before it's ready to step in. And then the question becomes, is this gap fill going to become a floor, or are we going to see it continue to deteriorate from there? If sponsorship is active, the sequence tends to look like this. But downside travel will slow first, closes start improving, and Microsoft starts reclaiming some of these lower term moving averages, backtest them, and then we'll see continuation from there. If sponsorship is fading, you get the opposite. The rebounds will start to fail. These tests of the now falling moving averages, these tests from the downside, if those continue to fail and price starts spending more time below these moving averages instead of retaking them, that opens up the scenario for continuation to the downside and gap fill. That's where it starts to get really interesting. So when we get into this gap and potentially coming down and closing this gap, is it then going to provide a floor for the price to turn around and use as support? And will we see demand step in at that point and push Microsoft higher? Really impossible to tell at this point. Very interesting that we have earnings coming up. So we would be watching very closely how price behaves around these falling moving averages. Is it retaking them and backtesting them and potentially setting up support, which would leave this gap open? Or is it failing backtests and continuing downward? If that's the case, that leaves this gap fill scenario more likely heading into earnings. If it can stabilize at this point, we might see a short-term reversal and a move higher. We'll just have to see how it plays out. Cycle mechanics tells us that if price is spending more time below the averages, expect more downside. If it's able to jump up and recover these shorter term moving averages on the daily, back test them and push higher, check the weekly charts, check the moving averages on the weekly charts. Is it also moving up and reclaiming the weekly charts and pushing up off of them? The dailies where we'll want to see it first, then we'll check the weekly, then we'll check the monthly and see if we've got demand restepping back in and we're looking at the next leg of the markup campaign. It's unlikely, in our opinion, because we have just seen these two big ABC corrective waves bracketing this upthrust here. Unlikely that we'll see more downside. Our expectation is that we may see this gap left open and the next markup leg continue from here. We'll have to see how it plays out. That's all the time we've got for Microsoft this week. We'll see you back here on the Trading Couch next.